What's up, Eeps? Hope everybody's doing phenomenally well so far this week, and thank you once again for joining us on the Daily Pills video stream of the day. My name is, of course, David, unfortunately, but it is 7:31 p.m. here on this beautiful Wednesday, May 22nd, 2024, and it is time to get everybody ready for the ticker tape for tomorrow, Thursday, May 23rd. So we're going to be talking everything market to today. I do have to sincerely apologize as well that I was not able to produce a video yesterday. I was too busy watching the Boston Celtics completely dominate once again. Actually, it was a very close game. They won in OT, largely thanks to this man right here. You know, you can make fun of him as much as you want, Jason Tatum, and say, oh, you know, he's not clutch, he doesn't do this or that, but the guy makes shots when it counts. And really, that is all that matters for me. 3 free throws. I mean, it was a great game yesterday. So yeah, I was kind of indulged by that, even though my softball team did lose. It was great to see that the Celtics actually came up with a dub. Speaking of losing, 𝗪𝗲𝗃 portfolio is down 37 basis points on the day. We outperformed the S&P because they were only down about 27 basis points. And the point is you want to outperform, right? Like you want the higher number. Maybe not when it's going lower, but you know what? I'm trying to get any kind of win here because we are up approximately 9.99% on the year. Call it 10%. We'll round up a little bit. Still underperforming both the S&P and the NASDAQ, but we are on our heels as usual. Warren Buffett shaking in his shoes. I mean, now that Jim Simons is gone, everybody kind of knows that 𝗪𝗲𝗃 is the best investment group in the entire world, and I don't think that's an understatement whatsoever. Now, it was pretty weird because our most recent recommendation for the Alpha portfolio, Enphase Energy, absolutely popped off. Nobody's surprised. It was up over 8.3% as solar stocks were just kind of ripping for the day. Now, we did have new names, tickers like Schwab that were kind of bringing us down, although Schwab is one of my most confident plays long-term. I mean, this just seems like the only asset management company that young people are even thinking about. I think the TD Ameritrade acquisition was one of the best things that they could have done because it kind of puts them, like, you know, Fidelity and Interactive Brokers aren't really competitors with each other too much, but Schwab is a competitor with both of them. Like, they have arms in each one of these markets, and, you know, with this $30 trillion or so in assets that are going to be turning over from old-ass people into cool young people like you and me, Schwab is going to be one of the number one places that people are going to go for this kind of stuff. It's the easiest platform, great marketing, great reputation. So we're very bullish on them long-term, although, of course, in the short term, they have earnings coming up tomorrow, I believe, or it might have been today even. But you know what? Market wasn't excited about earnings in Q2. We can give a fuck about one quarter. We're here for the long term, 3 to 5 year holding period. It's kind of our standard view. You know, Buffett's is forever. We're not that smart, so we'll stick with 3 to 5 years for now. Let's go ahead and get right into some of the banana bits, however, before I keep yapping and this goes to 20 minutes again. So first and foremost, J-Pow in the Fed minutes. Seemed like the Federal Reserve and, you know, the members of the FOMC were starting to get a little bit more nervous about inflation in their latest meeting. Now, it does make sense. They probably should, given the recent uptakes, but clearly they haven't read our latest inflation report published under 𝗪𝗲𝗃 as well, and seeing that all of these fears around inflation are, quite honestly, bullshit outside of the housing stuff, which we'll also talk about in just a quick minute. OpenAI, they struck another deal with a media publisher. In other words, OpenAI is continuing to rob media publishers of their IP. I don't know why these media companies are licensing out their IP like this. Now, today it was for basically News Corp. So think the owner of Wall Street Journal, Barron's, 𝗪𝗏𝗏, yada yada. They basically licensed out their IP, their articles, all that kind of stuff as training data for OpenAI. New York Times is doing the same thing. So, I mean, in theory, if all of these companies just keep licensing their shit to OpenAI, why would anybody get a New York Times account? You would just have an OpenAI account. Why would anybody get a Wall Street Journal account? You could just ask OpenAI, and it's going to tell you the exact same thing. Once again, they're cannibalizing their own business, just like they did when, you know, search companies like Google were starting to blow up. I don't understand this business strategy. It's the same thing as Reddit licensing out their data as LLMs. Do what Disney does. Use your IP. Like, make it valuable. Do what Apple does. This is what the biggest companies in the world do. I don't understand this. Somebody explain it to me down below. Give me the ball case to this kind of a deal for News Corp or for the New York Times. I don't see what it is. Now, moving on down below, solar stocks, like we mentioned, absolutely popped off for the day, so go ahead and check that out. Best place to check it out is, of course, within 𝗪𝗲𝗃. And finally, we just got some recent data on CEO pay. Median pay for S&P 500 CEOs was up about 8-something%, and half of them earned more than $15.7 million. That was kind of the median pay right there. That's more than I'm ever going to make in my entire life, especially if my dog keeps having to get surgery. It cost me fucking thousands of dollars because insurance won't cover it whatsoever. Whatever. We can talk about that another day. I hope I get to absolutely rip apart Lemonade stock at some point in the future because, god damn it, they are screwing me over right now. Anyway, let's go ahead and get into the macro monkey before I start crying on camera. So, it could be worse, and of course we're talking about the housing market right now. That's why I have this chart up and ready for us this entire time, just in case you've been wondering for the 5 minutes and 20 seconds that this has been going on. Time is going this way in this chart, so we're seeing this gradual decline as of right now, and of course, what could that be? Well, it is existing home sales in the United States. So the National Association of Realtors came out with the latest data on existing home sales. They call it the April report, but it's based off closing data. So in order for this to be based off closing, this has to be sales that were agreed to in like February, maybe March, mostly February, probably a little bit of leftover in January as well, just given how slow this market actually moves. So that's what we're seeing right here. Total existing home sales in the month of April fell to 4.14 million for the year. That's an annualized, seasonally adjusted rate, and that is a 1.9% decline on both a monthly and an annual basis. So obviously, that's not ideal if you're a home buyer. You want to see activity going. You want to see people buying up houses. Like, ideally, you would see prices falling and, more housing supply coming online. We'll talk about both of those factors in just a quick minute, but seeing a decline in home sales means there's going to be less liquidity. It gives more power to the sellers in the market. So while that's not great to see, it's not like the housing market is crashing whatsoever. In fact, it is doing the exact opposite. If we go ahead and take a look at the median sales price of one of these homes, we can see that that has continued to increase as well. So median price of existing home sales in the U.S. is up to $407,600. Most of that is driven by the Northeast and the West, where people actually want to live. Despite the horrendous weather in the Northeast and the extremely high taxes in both of these regions, those still seem to be the hot markets. Although the South is continuing to completely dominate. 46% of the existing home sales in April were made in the South region in the United States. That's where the 𝗪𝗲𝗄𝗀𝗀𝗀𝗀 global headquarters is based out of down here in beautiful Charlotte, North Carolina. So we really can't complain, although I am, moving back up to Massachusetts for, quite honestly, fuck knows why. But either way, nationwide, the median sales price increased 5.7% on an annual basis. That might not sound too bad, but it's not ideal to say the very least. So what this kind of tells us so far, given that we've seen sales decline while prices are still increasing, normally if you see volume go down, you'll see prices go down as well. I mean, if this was like a company or something, so that they could drive continuous volume. But the housing market's a little bit different. So when we see prices increasing while sales are falling, that just speaks to how much power sellers have in this market, and that housing inventory is really through the floor, pun intended. And so basically, what we saw was a slight improvement in terms of housing inventory. So the total inventory on the market for U.S. housing right now is about 3.5 months worth of buying supply. Whereas in March, it was about 3.2 months, and in April of last year, it was 3.0 months, just 3 months flat. So that is extremely low compared to pre-pandemic levels, and especially compared to pre-GFC levels, where it would be over a year at times, and pre-pandemic can be more like 8 or 9 months. So it's pretty insane to see that this is taking so long to recover. But, given the trends of work from home, of all these other dynamics that have been going on, I mean, I can't really say I'm too surprised, but Jesus Christ, sellers have so much power in this market. Now, a lot of this data and the dynamic going on here is driven by this chart right here. So you definitely can't read this, but it says percent change in sales from a year ago by price range. So this is the increase or decrease in sales for houses in certain price range that they designate down here on the x-axis. So houses below $100,000, we'll call them shacks. Those are down 7.1%. That's probably what I'm going to be needing to buy, quite honestly. We have $100,000 to $250,000 houses. Those sales were up 0.1% during quote-unquote April. Now $250,000 to $500,000 up 7.6%. We start to get some territory. $500,000 to $750,000 up 17.1%, $750,000 to $1 million, 23.8%, and $1 million plus is 39.7%. What does this mean? So the biggest takeaway from this chart is that obviously most of the growth is being done by rich people. Those are most of the people doing the buying. Now we actually had an increase in first-time homebuyers in the market right now, but that has to be people getting money from their parents, because all of the growth is in the plus $500,000 range. And I don't know about you guys, I don't know many people who are first-time homebuyers that can afford that kind of bullshit. So seeing most of the growth is done in these higher-priced homes, that is going to pull up the median sales price that we see kind of in the... It's going to pull up the median sales price that we see in this data overall. And so when we initially look at this chart right here, which is showing the amount that existing home sale prices grew each month, so it's kind of a rolling growth rate here, we see in April of 24, it was 5.7%. That is the highest amount on this chart. We've been seeing a steady increase the whole time. So that would tell you that home prices are not only increasing, but the rate of increase is expanding as well. Once again, most of this is going to be due to this chart right here, that rich people are kind of the only ones going out here buying homes right now. So that's going to pull up the median, and it's going to pull up the average price even more just because of the weighting of that price tag. So all in all, what do we have here? Despite declining home sales, there is still robust demand. Demand remains high. We can see that by prices continuing to increase. High demand and low supply, like we said, is going to continue to push up prices. And the concentration of sales growth in the $1 million push range might be artificially inflating that median sales price nationwide. So this is the kind of market where, yes, you can look at the nationwide data and say, okay, that's great to know in terms of context, but it's extremely regional, extremely state-based, and even more so, extremely locally. So you really got to take this one at a time. It's not like stocks. It's not like commodities or anything. Like, this is basically the complete opposite. That's why Zillow and Redfin and Open Doors market-making businesses completely fell apart, because it's a very different market than what we're used to. So on our takeaways from here is young people are still getting fucked. I mean, I know this firsthand. I'm getting fucked every single day. I promise you that, with all these goddamn loan officers that keep fucking calling me, offering me God knows what, trying to destroy my credit. Then this isn't going to change for quite a while. The only thing that is going to work is 𝗪𝗂𝗪𝗀 and a hard out there building fucking houses for us. So the least he could do is at least start a GoFundMe or some shit like that to raise money for people like me to have a house. Quite honestly, I could care less about anybody else. I just want to be able to afford a decent home in a good location. I know that is extremely selfish, but fuck it, this is the Daily Peel, this is finance, this is what we're about here, right? Maybe it's time to kick grandma out of the house, take over, let her be homeless for a little bit, see how she fucking likes it, quite honestly. That might be taken a little bit too far, but either way, perhaps the best way is really just to get 𝗪𝗂𝗪𝗀 to put on a hard hat, or at least raise some fucking money. Maybe at least buy some more MBS or something like that so that we can decline mortgage rates a little bit, hopefully increase some of that selling activity, lower prices. That's my dream world, but it is not going to happen anytime soon. Moving on into some of the big stock movers of the day, let's talk about what's right. First and foremost, we have Analog Devices. This is one of those companies that hires people so smart that they make shit that I can barely even pronounce. So I call it an Internet of Things hardware maker, because it basically makes like sensors and all these other kind of devices that smart people use. And so even though the S&P 500 fell from all-time highs on the day, Analog Devices was able to remain at an all-time high, up 10.9% on the session for very solid earnings. So it wasn't even necessarily the earnings that did it, of course, it was the outlook going forward. CEO Vincent Roche said that they're seeing a cyclical recovery, so that got markets very fired up, and it's good news for the kind of device manufacturing sector. Moving on into TJ Maxx. Couldn't have a more opposite company, but we have TJX and companies right here. This stock was up 3.5% on the session, once again for solid earnings. The downside is that solid earnings for TJ Maxx mean bad earnings for everybody else. We'll see that with Target in just a quick minute, because if everybody's kind of flocking to TJ Maxx to the point where they're dominating earning estimates, while they did in the last quarter, that's kind of a bad sign. It shows that consumers across the income spectrum are starting to go for the cheapest option, and that's generally not a good sign for discretionary spending if we're resorting to TJ Maxx for everyday purchases. Now, don't get me wrong, I fucking love TJ Maxx. It's one of my favorite stores. I love going there to buy gifts for people. So if you've ever received a gift from me, it was probably some bullshit secondhand, or the manufacturer made a mistake and TJ Maxx got their hands on it. Moving on into some of the what's rotten names, however, we have Williams-Sonoma. So Taylor Swift, expect her to drop a new album any day now, especially if she is a shareholder in Williams-Sonoma, because the heartbreak that investors must have felt today is something I can't even imagine. So the stock was up over 9% at the open. At 9:30 a.m., the stock was up, 9.6% from Tuesday's close. So it absolutely popped on the day. However, the stock then subsequently plummeted 18.7% intraday and ultimately closed down 11% flat. So what happened? Basically, analysts started to read. They turned on their reading comprehension abilities, and even though Williams-Sonoma reported a 70% jump in profits, they had increased guidance for both revenue and margins. They dominated their EPS expectations, reporting $4.07 versus the $2.67 per share that was expected. Really, the only reason I could see as to why this stock fell was because of that existing home sales data. This is a home goods maker, and if existing home sales and home sales at large are declining, we can kind of assume that Williams-Sonoma sales are going to decline as well. Moving on down below into Target, which we'll be diving very deep into tomorrow. Target was down 8% on the session for trying to save America, quite honestly. They are out here on the front lines fighting inflation by lowering their prices, and the market couldn't give a damn. In fact, the market's upset about it, and that's why the stock was down 8%. They missed on earnings by about 0.98%, so less than 1%, but about 98 basis points. Sales beat by about 6 basis points, so, that was some upside, but the CEO, Brian Cornell, really put the nail on the coffin when he said that they're seeing, quote, continuing soft trends in discretionary spending. Obviously, that is a little bit worrisome, so that's why investors were selling off today. Finally, earnings spotlight of the day. We have Nvidia to talk about. Finally, Nvidia dropped their latest earnings report. So, this is really kind of going to determine the market's fortunes over the next 3 months, because it really has been the Nvidia and the OpenAI story so far. So let's go ahead and find out exactly what the stock is doing right now. It is ripping higher after hours, and it is still elevated as well. So let's talk about some of the numbers. What direction do you think these numbers are going to be going in? I bet you have a guess. And if your guess is anything besides up and to the fucking right, or maybe the left from your perspective on this screen, go get your IQ checked, because you definitely need some help. So Nvidia completely dominated once again. Oh, I don't want to go to those charts yet. Nvidia completely dominated. What we're seeing right here is their revenue growth in the first quarter of fiscal 2025. For a company that's really good at counting money, they do struggle with counting the calendar. However, they did set a new revenue record at $26 billion. That is an absolutely insane growth rate, in case you were wondering, in case it wasn't obvious already. Sales beat estimates by 7.02%. They were 18% higher than in the prior quarter. Revenue more than tripled on an annual basis to that $26 billion level. Completely ridiculous. Absolutely abhorrent levels of growth. It's fucking insane that they were able to do this, so we're very impressed. Now, if we kind of break it down even more, so data center revenue was up 427% compared to last year, because now the company is on this new idea of AI factories. They're factoring in a fourth industrial revolution, is what they're calling it. The AI factory is kind of the new driver of this. So I guess instead of relying on smoky buildings and child labor, we're going to be relying on Nvidia's GPUs and whatever the fuck these LLMs do behind the scenes. So if we go a little bit further down the income statement, we can find their quarterly net income. And what do you know? It absolutely exploded during this quarter as well. So net income rose to $14.9 billion, an insane 621% leap from last year, from the same quarter of technically 2023, but Nvidia calls it 2024, and it was up about 21% from the prior quarter. So it was absolutely ridiculous. Not only were they able to smash revenue estimates, but they continued to cut costs, probably because of their own artificial intelligence. And then finally, we move on to their free cash flow generation as well. This one was the craziest of all. Basically, free cash flow clocked in at an insane amount, roughly the same as net income, quite honestly. It was like $14.9 billion, or just about in that territory. So that was insane growth levels as well. In total, I think it grew something like 465%, $14.94 billion in free cash flow. Absolutely ridiculous. Now, it's just completely, there's nothing I can say that's going to encapsulate how impressive this growth is. The big takeaway is, as goes Nvidia, so goes the market. So the fact that Nvidia did beat on earnings and the market likes it so far, it's up 7.2% after hours. That bodes very well, at least for the next 3 months. The next time Nvidia reports, then we'll have our fate sealed once again. All right, that about does it for us today. Of course, we want to finish off with a quote from Nvidia CEO Jensen Huang. One of my favorites from this guy. He said, "Never stop asking questions and seeking answers. Curiosity fuels progress." Now, when you're somebody like me, you don't really have answers to anything, so you're constantly asking questions. So I guess that must be fueling some kind of progress along the way. I'll let you guys know when I make any kind of progress whatsoever. Trust me, you'll be the first to hear it. Thanks for joining us once again. Go Boston Celtics. Go, who do I want to win? Probably the Timberwolves tonight, because I think they'll be way easier to beat when we inevitably make it to the finals. So shout out Celtics, shout out Jason Tatum, shout out the stock market, and of course the 𝗪𝗲𝗄 portfolio. Go check things out. Go trade alongside us, make money alongside us, bully us when we lose money, yada, yada, yada. I'm going to shut up so that this stays under 20 minutes here today. All right, thank you, apes. I will hopefully see you tomorrow, though the Celtics are playing once again. It is 7:51 p.m., so worst case scenario, you'll see me the day afterwards. Thanks for tuning in. Happy investing, happy trading. Bye now.